All right. What I wanted to do is give it a little bit more of a directed course type stuff. So whenever we come in and do these classes, I know we've been doing them for a while, and we do have kind of the intro classes back at the beginning, but not everybody that is here now was here then. So what I'm going to do is go through a crash course, and as you guys know, one of my biggest the parts of what I try to do is simplify smart money concepts. So I'm going to try to do just that, and we're going to jump from market structure to points of interest to liquidity to the time of day, and then really just how to build a trading system. I'm aiming to do it in under 10 lessons. I wanted to, again, I just want to be. It's not gonna be as directed as far as we're not gonna type things out or have an outline. I'm just gonna show you guys kind of on a practical level how I view the market. So first today we're gonna go over what is really the most important aspect in any trading plan, whether it's you know in my opinion, anything. It doesn't have to be smart money, but if you're trading, markets, you're paying attention to what your market structure. You've got your highs and lows. Whether you're a trend line trader, whether you're trading supply and demand, whether you're trading whatever it is, you're most likely incorporating market structure. So, on a very simple level, we all know that market structure is highs and lows, but there's a lot of different ways to map this. So, if we have a handle that is, take me a second to draw these. So if we have a candle that is this specific formation where we have one candle in the middle with a high that is higher than candle on each side of it, that can be considered a high. So whenever we're talking about smart money, a lot of people, they want to see, and I am going to go into how to use this, but a lot of people want to use only highs and lows that created new highs or new lows, which there's nothing wrong with that. And we're going to go over different ways to do this, but there's different words: swing structure, external structure, or some people even require this on an internal level. So the way we're going to view market structure is a little bit more free flowing and more adaptive, and we're going to be focusing on one key element, and that element is displacement. Because in smart money, if we're looking at the markets from the perspective that the markets are always being manipulated, then not every single high or a low is going to give us what we need out of a high or a low, which is proper bias. So whenever we're trying to trade with the larger institutions or with big money, we're going to need to use displacement, because if a large institution is getting involved into the marketplace, it's not going to be a candle like this, where we have, maybe let's say we're coming up into a old high. Give me 1 second. Hold on 1 second. I got my little one here. I had to go do something with her. So if we have a high that, let's say we take an old high over here, and we'll say this was the old high, the old level we took. Well, if the market came up into this level and then it consolidates and barely comes up and takes out that old high like that, wherever the low was that created this high, we're going to expect that low to be taken. So not every time we make a high, we're going to consider it a high. We want to make sure we use, actually I'll keep that up. We want to make sure that we use displacement in our trading, because without displacement, we're really not able to trade effectively with, smart money, so to speak. So we have two different types of structure that we're going to be focusing on. The first is going to be external, and this is also known as swing structure. So whenever we're talking about price and we have these large moves, let's say if let's do this over here. If you're just looking at this leg of price, you might say that this is multiple different legs of structure, that, we're going from, low to high to low to high to low to high. But what if the last leg in structure looks something like this? So this is where a lot of people mess up, and they're going to map out every single leg of structure as if it's in an external range, and then we're going from bull to bear to bull to bear. They're going to say we're bullish here. Let me get a highlighter so this will be easier. Bullish here, right? Bullish. And they might say, oh, we had to change the character, and then they get stopped out. Bam, now, okay, now we're bearish again. And you can see how you can easily go all over the place with this, and you might have thought you were bearish this whole time simply because you're not mapping out your external structure properly. So whenever we're looking at external structure, it's very important to look at what is, a relative swing look like. So let's just take a look at price over here. So for instance, if we're looking at, let's go on the actual chart. So if we're looking at the structure of this chart, and we're looking at each high and low, each high and low, it's gonna be really easy to think, oh, we switched bearish there, but that's just not the case. So whenever we're talking about a swing, an external leg in price, we want to make sure that we have a large push, and there's going to be lots of internal structure in between that. So you want to look at the chart, and you want to say, what are the points that we've really moved away from? And then look left from there. So obviously on this chart, we're going to go from here. So if we look at, this right here, or this right here, these moves from these lows up to here are not that much. And also, they didn't really take any old highs. I mean, they took out this, but again, this is just not, relative to this chart, this is not much in price action, right? So we look back, I mean, that little move is a blip. So that'd be an internal leg. But if we're looking at our external structure, we can see that this low we move pretty aggressively off of. So we're creating a range. We also took out an old high. So this is a pretty big move. So this is something I would consider an external range. Not this right here, not this, but the entire move. So we're trying to kind of catch all of the points in between all these small moves and figure out where the overall trend is going, because not every single move and structure is going to be a shift in trend. So let's just draw another model. So we'll say so in a model like this, you might just look at it like a bunch of squiggly lines, and that's fine. If this is just not making sense yet, I promise it will. Just focus. But let's say that this is our external structure, or let's say we're trying to find our external structure. So if we're trying to find our external structure, where is my highlighter? Okay, with that. Then, we're going to pay attention to all of these highs and lows, right? In terms of just, they are structure. This is where a lot of people get confused because say, well, that's a high. Why isn't that external? But again, we're looking at, what is the bigger picture? So again, it's external structure because there is a lot of structure internal to it. So that's where you're going to get the little highs and lows in between the peaks and troughs. So right here and here, these are 2 points that we moved. These are major pivot points. The market really shifted direction here. Did it really shift direction here? No, it kept going higher. Did it shift here? No, it kept going higher. What about here? Yeah, it did. Right? Now, another way you can visualize this is maybe each one of these, we're just moseying on down, little small candles, and this was a massive big push down. Maybe one big candle or very high volume candles that were showing an energetic desire to go down. So when we're looking at, where is price likely to continue? Well, if we're bullish, let's just assume this was a bullish chart. I know I'm not going to draw for infinity to the left, but we see it's a bullish chart overall. So the expectation is for us to go up. So the only reason we go down is to mitigate and for institutions to take profits. So again, where institutions are going to do that, we're likely to see this kind of price behavior above an old high, just like we saw it right here, see it up here, just like you will most likely see it above there if we're talking about real life examples. But we're determining where the market is likely to end a trend. It's going to be above buy side liquidity. Now, how can you, kind of complement that even more? Well, let's just say if here's your BSL, and for those who don't know, buy side liquidity can just be a high, right? It's an old high, because if we are pushing up into an old high, a lot of traders are going to look at that as an opportunity to buy a breakout. And then you have, on the other hand, all of the shorts who got stopped out because they placed their stop loss at that high. That creates a lot of buying interest in the market, and the market makers are going to then sell to those buyers so they can bring price back down to their old orders. So we're looking at where is the market likely to exhibit these signs of behavior. We're going to say that the market is likely to reverse. External structure is likely to start to pull back, not completely reverse to a new trend, but it's likely to pull back after we hit a pool of liquidity. Now, again, if you were looking at this from a bearish perspective, everything I teach you is going to be the same. It would just be our sell side liquidity, which is going to be a low, an old low, where a lot of longs are getting stopped out or a lot of people want to short, aka selling interest. So then the smart money would buy to them, only to pull price back up into a premium to then push it down. So again, I don't like wasting time with inverse. I get messages sometimes like, "What about a bullish example?" It's the same thing. It's literally just different number or different letter for that. It's the same exact concept. And the more you, why does it always do that? The more you familiarize yourself with, kind of methods to conceptualize things in trading, the farther you're going to go. Because again, people always say price is fractal, but a lot of the stuff we teach, or I teach you guys, is 100% going to be applied in numerous different scenarios, but in the same way. For instance, you can do this on a daily chart. You can do it on a 1 minute chart. You can do it an inverse of anything in trading, because we're playing a numbers game, and all numbers have an inverse. So, except zero. It's gonna be someone who's gonna troll and say that. But so in this example, we're looking at the market and we're trying to develop our external structure. So we're trying to pinpoint the areas where the market really turned around at. So did the market really turn around here? No. Did it turn around here? No. What about here? Yes. Right? So then we look again. So now we have a new range. And then where did the market really start to push up again? Was it here? No. Here? No. It's here. So we're mapping out external structure. We are trying to find our key ranges. So when we're trading smart money, ranges are extremely important because they provide us with a fair value of the range, which is the midpoint. So the fib tool I'm using is 1, 0, and 0.5. And they provide us with a premium, which is above the midpoint. So that's going to be a premium price. And this is a discount price. And this is all relative to this range. So whenever we are thinking like a market maker, because you always have to do that, if we're in a bullish trend, we want to buy in a discount. And you have to think about it in the sense of, well, I'm expecting us to come back up and trade higher because the market has been trading higher. Now, if you have a higher time frame telling you something different, like for instance, in this leg of price here, this was a bearish external swing on a lower time frame. So if this is on the daily chart, what we're on right now, then all of this on a 4-hour chart was probably look something like this. Right, on the 4-hour chart, it probably looked like a very bearish trend, but that 4-hour chart got violated. A lot of people probably were trading that the expectation the 4-hour chart was going to continue, but it did not. Down here, it turned around and came out and stopped them out. Now, why was that? Because they're not trading in context of the next time frame up. So it's very important to understand what you're doing on the higher time frames. So we have two forms of market conditions that we're going to focus on today, which is going to be our expansion, which is when we're going out and seeking out that expectational direction. So for instance, if your expansion on the daily, right, let's say right this leg in price right there, that was probably a bearish swing on a 15-minute or a 4-hour, but why didn't that continue and just continue going down? Well, because you came into a discount, probably into some form of area of interest, and then the market is now going into expansion mode on the daily time frame. So if you're expanding on the daily, you can go ahead and rule out anything that you've looked at on the 4 hour, anything you've looked at on the 1 hour, the 15, and the 5 minute, and you're going for this high. Now, it's not going to be one straight candle to it, but you have to have a bullish bias. So this is how you can use structure to determine your bias, and you use it by going from the top down. So if we're looking at structure in that perspective, that we are expecting it to go bullish, we're expecting up, we're just going to look for areas that we are likely to see that. So that's where we use this premium and discount. So if you're a market maker and the overall direction is up, right? You're taking price up. Well, do you want to buy it up here, or are you going to buy it down here? You're going to buy it down there because it's at a discount. If you're in it, banks and market makers, whatever you want to call it. I hate using terms because none of us really know. It gets to the point where it's like all conspiracy-esque, but market manipulators, they're running a very strict business. Now, if you're running a strict business where you have a product, do you want to buy it for a discount or a premium? Right? Common sense says you would want to buy it for a discount. Whether you're flipping cars, whether you're buying a product and selling it on Shopify, whatever you're doing, you're buying it for extremely cheap and selling it for a premium. So if we're looking to take price to the upside, then we want to look in a discount for areas to take it up there. So again, as day traders, if this is a daily chart, we don't have to necessarily catch this low right here and ride it all the way up here. But this is how we develop a bias. So all this time, this might have been weeks or months, but you were able to understand the daily as an expansion mode. So anytime we move down, that should be looked at as a buying opportunity. So all these pushes down may have been bearish swings on another time frame, but just because we understand the principle of external structure on a higher time frame level, we're able to understand that the market is likely to continue the upside. So all those down moves should be looked at as a buying opportunity to take up here. So whenever we're looking at retracements, which is going to be when we're coming back down to our discount, or if you're bearish, you're going to be going back up to a premium. Well, you're going to have multiple things that you can look for in terms of price, where it's likely to expand from. So just in terms of structure, if you have liquidity, right? Now, liquidity doesn't have to be just your major external sell side at the bottom of the range and the buy side. Now, if you're looking at this range, this is where the most buy side and this is where the most sell side is, yes. But there is still going to be selling interest under this low, under this low. There's going to be selling interest up here and up here. Just like there's buying interest here, 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 here. But it's important to understand, what you have to always trade in context. So yes, there's going to be sellers under here, but in what context? Is it going to be in the context that we're assuming, larger forces to buy it up? No, right? Because why? It's not in a discount. But if we look down here, all of these lows down here, if we're thinking like a market maker, we look to buy under these lows. Now, some of you guys who have, been around for a while with trading, understand you can also look for points of interest, order blocks, fair value gaps, breaker blocks, and we're going to go into that, but not in this lesson. So strictly using structure, we know that if we are a market maker and we're looking to take price up here, so I want you to think about it like you've got a gas tank, right? And every time you hit one of these levels, that gas tank gets a little more full. But you need that gas tank to be all the way to the rim in order to take price as far as you want to go. You want to take this and blast it up. It's going to take a lot of fuel to get that. So each one of these lows is kind of like a gas station. So you're going to be filling up the car. But remember, these massive moves in the market are going to be fueled by massive players. So they're going to need a lot of fuel. It's not like they're just filling up a Honda Civic. They're going to need to go all the way and clean out all of the liquidity that is internal to this range. So structure equals liquidity. All structure holds liquidity. And again, what structure is important? Well, if we're in a bullish trend, we're looking at sell-side liquidity in a discount because we're trying to buy from those sellers because we want to be with the market makers. So every time you come down here, you're hitting into little fuel stops. And finally, once price is full, once the gas tank's full, you're going to get this. And you're going to get it with displacement. Now, this is very important. So pay attention to this part. If we get a structural break with displacement after cleaning out all or the majority of the internal liquidity at a discount, then we expect price to expand. But until we get that, we expect price to continuously retrace. So as a day trader, if you're watching the daily chart and you're just saying, okay, well, we're in a bullish trend, you know, you're just watching this and you're not going to wait all of this to trade. I mean, maybe you do and you trade a lot of pairs, but this could be weeks. So, you know, if you're looking to trade, we don't have to just trade with the trend. We just have to understand the context of what's going on. Are we in a premium? Have we taken out an old high? Have we had a shift with displacement? Well, if so, we're seeking out lows in a discount. So this structure, notice how I said if we take displacement there, that is our signal that we're going here. So again, the external structure is the major range. The internal structure is any high or low in between those 2 points. Some internal structure is important, some is not. We can expect small pullbacks from each level of internal structure, but we wait for a displaced push, this energetic push, to tell us that the market is going higher. That right there, that is the market showing its hand. That's why I want you to think of that, a market structure shift, change of character, whatever. But one thing that I have learned from trading this price action for quite a long time now, and just a lot of different pairs, displacement is everything. Without displacement, you don't have shit. And that one simple fix will eradicate so many losses if you're learning how to trade smart money, is requiring displacement. And you might get FOMO and see a trade that doesn't have displacement, and then it works, and you go back to your old strategy and not requiring it. That's how you break yourself. But I promise you, if you just stay disciplined and just incorporate displacement, right? Now, some of you might be wondering, what is displacement? So let's just take a couple looks on a chart, because this is something that's going to be easier. So let's say if I look at something like this right here, is this displacement? We're just looking at just this leg in price. That is not displacement. Why? Because we came up and we tapped the wick and pushed our way up from it aggressively. Now, it did come back down and sit under there for a little bit, but that's not displacement. You know what's displacement? It's something like this. This leg in price. That is displacement. It's a very energetic push. You know, when we're talking about the stock market or any Forex markets or any of the major crypto markets, it takes a lot of money to do something like this. So if we see that, we know that it was sponsored by the forces we're trying to trade with. So at this point, you know, after price comes back into a premium of that range, you see it goes down and seeks out the lows. So again, you know, the camp took a high, so now we're coming back into a premium. Price moved around here for a little bit and then expanded towards the low. And it's probably a little bit cleaner on a lower time frame as far as the internal structure, but the main takeaway we have is displacement. So when we look at this, price came back up, and if we talk about this entire range, so notice I drew it like this at first. Am I going to draw a whole other range right here if there was no displacement? No, I'm not. I'm going to extend my range. So now we have the true range. So this is where a lot of people get messed up. They're going to say here, okay, there's that. I got a candle close right here. And I used to trade like this. But, you know, you'd say, okay, well, there's that. Here's the lowest point. So, oh, what the fuck? You know, I shorted above this high in this order block, and I got stopped out. This shit doesn't work. But it's just simply just not correct structural mapping. So, you know, when we want to map external structure or any structure, we want to require displacement. So not only candle closes, and this is where it gets discretionary. This is just how I do it. But that to me is not displacement. This isn't displacement. This is just consolidation. So then I'm going to add all of this as one level. And now look what happens. Price comes up, takes out the equal highs in a premium. Massive sell-off. So that's where the true move, and then now you look at this. Is this displacement? Absolutely. It gets a little choppy right around here, but then you have this massive gap down and a push. That shows the market is going lower, right? And then if we look at the next leg in price, is this going to be our only range? Right here. No. And I'm going to give you a reason why. It's not necessarily this time frame, because a lot of you are like, what do you mean? That's displacement. It is, but this is where you have to operate in the context of the higher time frame. So you're always going to be looking at your weekly charts. Why is this not? There we go. So if we look here on the weekly chart, we're really looking at this in the sense that, is this a range? Yes. Is this a range? No. We're going to be looking at it in the sense that this right here, because this move is not enough to create a whole new range. No internal structure was even taken. If you just look at them, you just look at that 3 candles compared to this or this. So you're going to incorporate this as one range. So that's why you have to always be operating in the higher time frame context. So a lot of people would have went bullish and said the market's going to be bullish, and stay bullish above those highs when it's just not. We're not looking at these small little moves in price that happen in a very short amount of time to be in an entire external range. So let's just say if we have this, this is 30 or 51 days right there. 50 some days, 50, 53 here. Let's see it exact. 51 days. So are we going to say that from this high to this low, that 16 days is a new leg? No, we're not. These sharp moves we're looking at as manipulation. So if we look here again, and we actually longed on this day, somewhere right in here, into these highs. And we talked about this. You can actually watch a video of this live, or at least the bias. It was on July 6th, and this candle. It's on my YouTube, just to get an idea of why I thought we were going for these highs. But the ideology is that we have external legs because they're external. They're large moves in price. So all of this internal structure in between is just telling us what behavior is relative to this range. So if we have bullish internal structure here, so we have a high, low, high, we take out displacement. So does that mean right there that we are bullish overall? No, but it means we are short-term bullish to go to a premium. So then we look at, as soon as you get that shift, you look for price to go to areas of liquidity at a premium. So the internal structure, I know we've talked about mainly external structure, but really everything that I've went over about internal structure is what's important. So internal structure tells you what the external structure, what the behavior of the market is relative to the external structure. So if we have a bearish external range, or we'll just use this, we have a bullish external range. If we get displacement down and we're in a premium, look for discount liquidity, but do not look for the low, because the expectation is to go up. So if we're coming down, it's just coming down to go up. Now, if we look at it in the sense from this area, if we take out a high with displacement after clearing out internal liquidity, you're going to target this, because remember, price is bullish. So another saying that a lot of people use to remember this is price moves from internal liquidity, right? So we take out internal liquidity here, to external liquidity, and then back to a discount, or back to equilibrium, sorry. So after you have to remember from internal liquidity, so here, took out something over here, push up, we went to external liquidity, price came back down to a fair market value, but of course it always goes to a discount or premium. But we look for it to come past this level, into internal liquidity, into external liquidity. Again, back to fair market value, back to internal liquidity, and then you wait for that shift. Because just because this happens doesn't mean you're 100% going to continue up. You wait for,